Why your brain fears investing more than losing money. Finally, you put $500 into an investment account. The market is down the next day and you're unwell. But to leave that money in the bank account while prices slowly eat it away? Somehow that seems secure. Your brain will freak out about a $20 loss, but ignore hundreds lost to inflation. This is due to 3 hidden traps. And the third one is that doing nothing can feel safer than acquiring wealth. As soon as your balance goes red, the first trap is triggered. Suppose you buy a stock at $100. In a week, it'll be worth $90. That $10 feels like a personal loss. You choose it. You press the button. Now it seems the red number is evaluating you. But if $100 in your bank account is worth less next year, there is no red flag. You might have still $100 balance. So your brain doesn't see any loss. That's the trick to it. Visible losses scream. A secret loss is speaking. But here's what makes it even weirder. Your brain doesn't react the same way to losing and gaining. It was good to come upon $20 in an old jacket. A $20 bill out of your pocket can spoil your whole afternoon. The same. A much different response. Losses usually hurt more than equivalent gains feel wonderful. That's why one poor day in the market can seem more powerful than months of gradual progress. Your brain doesn't go, "What's going to help me in 10 years?" It's saying, "How do I stop this pain now?" So you sell, or you just don't start. And thus the terror has gone for a moment. But that relief can be incredibly pricey. Selling after a fall turns a brief tumble into a serious loss. Avoiding the market indefinitely relieves the pain, but loses the opportunity to flourish too. Imagine not wanting to get behind the wheel because the idea of driving feels dangerous. Staying parked prevents an accident, but you never get to your destination either. The aim is not to avoid risk. It's stopping to treat every uncomfortable feeling like a sign of danger. If that distinction is already clicking for you, leave a like. It really helps this reach more people. Now, trap number 2. Cash offers you an illusion of control. You open your bank app. There's money in there. Yours still, available at any moment. That feels nice. Investments move every day. Get up, get down, up again. You can see it alter, so it appears less reliable. But steadiness on the screen is not stability in real life. If the price of groceries, rent, insurance, and electricity goes up, your cash is less powerful, even if the number never fluctuates. Your account seems to be frozen, but the world outside it isn't. And this is where "I'll invest when it feels safer" is a trap. When the market goes up, you believe prices are too high. When it drops, you believe it's too risky. When there is no news, you wait for a better time. When the news is scary, you wait for the scare to dissipate. There is always a reason to delay. So the perfect time never comes. Not because the market never gives it to you, but because your brain continues shifting the definition of safe. You may have heard that smart investors know when to get in and when to get out. But most ordinary folks do not require a crystal ball. They need a system that responds when the emotions are loud. Imagine 2 people. You wait for the right moment and invest only when you feel assured. The other automatically invests a modest sum each payday. Sometimes the second individual will buy before a dip. That won't feel good, but they will buy when prices are lower too, without needing to be daring. The system keeps on going when fear whispers, "Not today." Quick question. Ever told yourself you'd start investing next month and found another reason to wait? Let me know below. Waiting might often feel like the prudent choice. That sounds prudent, adult patient. But sometimes waiting isn't a plan. It's terror in a business suit. A real plan has a date, a sum, and a rationale. "Someday I'll start" has none of those. And once you realize that difference, you can't not see it. But trap number 3 is deeper than money. Your brain is striving to preserve your identity. If you never invest, you can convince yourself, "I could have done good. I just didn't want to chance it." But if you invest and lose money, even if it's temporary, then another thinking comes up. Maybe I'm not good at this. Now the loss is not only economic, it feels like evidence of who you are. That's why individuals look at their assets 10 times a day. They are not only counting the money, They are determining whether their decision was correct. But few things are as counterintuitive as investing, where a smart decision might look bad for months, even years. You can have a reasonable, diversified investment, and yet have it go down. That does not mean the choice is necessarily stupid. A seatbelt is always a sensible choice, even if you never crash. And wearing one doesn't mean you won't get wounded. Making good choices improves your odds. They don't determine all the results. That slight change is big. You don't say, "Did this go up today?" You start to question, "Is this still part of my long-term plan?" The point most people miss is this. Fear isn't always advising you to stay away from investing. Sometimes it's informing you that your plan is overly aggressive. If you're losing sleep over a market decline, you may be investing in money you'll need shortly, or taking on more danger than you can bear emotionally. It doesn't mean you're weak. This suggests that your strategy and your real life are not in sync. Money for next month's rent shouldn't be on a roller coaster ride in the market. Your emergency fund shouldn't either. Long-term money is another thing. It has time to recover from rough patches. So how can you begin without battling your head every morning? The first stage should be virtually uninteresting. Keep some cash for emergencies. Choose a minimal amount you can put aside on a regular basis. Use a broad, diverse option you know. Automate. Then stop looking at it every hour. Checking your long-term investment every day is like planting a tree, digging it up every morning and asking why it's not growing. You don't have to have no fear. You need a plan to work when you are scared. And now the opening enigma was clear. Why your brain is scared of losing more than investing. Investing makes the choice obvious, the danger obvious, and the person to blame obvious, you. But inflation, missed growth, and years of waiting leave no startling red number. There is no one moment of pain. The loss is silent, spread across thousands of routine days. Your brain is most receptive to what you can perceive this very moment. Your future pays for what it can't see. So the real opposite of investment is not safety. It's a different kind of risk. Market risk is noisy, silent on risk of inflation. Emotional decisions are made quickly. Loss possibilities are almost invisible. You don't have to put every dollar you have into the market. You don't have to forecast the next crash. And you definitely don't have to be courageous. You only have to learn to see when fear is defending you and when it's sneaking off with your money. Begin with little steps. Keep it up. Give time a chance to do the heavy lifting. If this shifted your perspective on your personal financial decisions, subscribe so you don't miss the next one. And hit the next video to discover the common money habits that can make you feel broke, even while your income continues to grow.